All right, let's dive straight into this explainer. Today, we're going to absolutely shatter the glittering illusion of the real estate industry and look at the cold, hard numbers actually driving it. You know exactly what I mean, right? You've seen the highway billboards, the agents driving luxury cars, heard those legendary tales of people buying a couple of houses and basically retiring by 40. But today, we're focusing heavily on the underlying architecture of this industry. Specifically, we're going to explore the 7 distinct models that dictate who actually makes money and exactly how they do it. Here is our roadmap for today. We're going to cover the real estate myth, the 7 distinct models, the brutal transaction math, customer acquisition, luxury versus mid-market, and finally, systems over sales. Part 1. The real estate myth. To kick things off, we really have to unlearn what we think we know about those sold signs. The math most people do in their heads while sitting in traffic staring at a real estate billboard, it is completely divorced from reality. I mean, when a house sells, that pile of cash doesn't just magically slide across a table from a buyer to an agent. It splinters. The bank takes its mortgage payoff first, for sure. Then the government takes stamp duties or transfer taxes. Then the title insurance company grabs a few thousand. Then the closing attorney, the appraiser, the staging company, the drone photographer. By the time we even get to that famous real estate commission, the pie has literally been sliced a dozen times over. Part 2. The 7 distinct models. So, real estate isn't just one business. It's like a giant puzzle made of at least 7 different models. And honestly, this is absolutely crucial to understand if you want to know how wealth is genuinely generated here. You've got brokerages, which just connect buyers and sellers, direct property investment, where you hold assets for appreciation, property management, where you don't own the buildings, but you get paid to run them. Then there's real estate development. That's high-stakes construction where you can make millions or, completely lose your shirt just because the price of drywall spiked. And finally, wholesaling, house flipping, and rental portfolio investing. When most folks say they're getting into real estate, they usually just mean a brokerage. But the risks across these 7 models are wildly different. Just contrasting these models reveals how varied the whole landscape is. Take the volatile income of a brokerage or development and compare it against the highly predictable defensive income of property management. In a brokerage, you're facing high cash burn waiting for unpredictable sales to close. In development, sure, you might make a massive profit, but it's incredibly rare and the risk is staggering. One bad zoning issue and you're ruined. But property management, you're collecting 8 to 12% of gross monthly rents to oversee daily operations. Those fees arrive every single month, whether a house sells or not. It's really the steady heartbeat of a mature empire. Part 3. The brutal transaction math. Since most people equate real estate with a brokerage, let's zoom in on exactly what happens to the money in a standard transaction. Think about a typical $500,000 American home with a 5.7% commission. That $28,500 instantly fractures. The buyer's brokerage takes roughly half. The listing brokerage takes the rest, but they only keep about 30% of it, sending 70% to the actual listing agent. That leaves the brokerage with just over $4,000. And remember, out of that $4,000, they still have to pay franchise royalties, office rent, software subscriptions, the whole shebang. The actual net profit for the brokerage is often under $2,000. And what about the agent? Well, after paying for drone photography, digital ads, vehicle wear, and roughly 30% in taxes, their actual take-home on a $500,000 transaction is less than 1% of the sale price, $4,431. Literally less than 1% reaches the person who just spent 6 months earning it. It's not that agents are underpaid, it's that the transaction model itself is fundamentally thinner than anyone realizes. Actually, scratch that. The real killer here is the structural cash flow mismatch. You are paying monthly overhead for up to a year before a single dollar of revenue actually arrives. A standard sales cycle takes between 180 and 360 days from the very first contact to a closed deal. So those Google ads you bought in January, you might not see a commission check for them until October. This staggering startup cost is exactly why the majority of brokerages fail. They literally just run out of cash trying to survive the gap between their first expense and their first check. To cover state licensing, commercial rent, CRM software, ads, liability insurance, you need between $50,000 and $120,000 just to turn the lights on. They don't fail because the model is flawed. They fail because they underestimate the massive cash flow valley they have to cross. Part 4. Customer acquisition. Surviving that cash valley brings us to the next massive hurdle, the sheer cost of earning a client's trust. Real estate is fundamentally a customer acquisition business. Securing just one paying client costs a national average of nearly $800 in saturated digital marketing channels. In competitive markets, a single click on a Google ad costs $5 to $15, and out of 100 clicks, maybe 1 or 2 become paying clients. You are burning through hundreds of dollars for a lead that will take 6 months to close. Plus, you're fighting a huge trust deficit. A buyer doesn't want the brokerage that opened last Tuesday. They want the brand they've seen for 20 years. This is so different from the other models. A house flipper doesn't need to acquire a retail customer's trust like a broker does. They just need the capital and the math to work out. This dynamic shows exactly why reputation is the only sustainable escape from expensive advertising loops. Veteran agents, those with 16 or more years of experience, pull nearly 70% of their business from near zero-cost referrals and past clients. That is built-in trust acquired at practically zero cost, and it's a real game changer. It is the decisive financial difference between the survivors and the casualties. Part 5. Luxury versus mid-market. Let's tackle another pervasive myth. We all see the reality TV shows and assume bigger houses equal easier money, right? The idea that selling luxury properties is a shortcut to incredible wealth. While a luxury listing looks glamorous, the reality is that volume and consistency in the mid-market almost always beat the high-risk, slow-moving luxury tier. Selling a $5 million estate can take over 150 days. It requires high-end film production, architectural staging, and a $25,000 marketing budget before a single buyer even tours it. Compare that to mid-market homes, which turn over in a median of 53 days. Mid-market buyers are driven by life events, growing families, relocations, and those events just don't wait for perfect economic conditions. We also have to consider structural economic factors like sudden interest rate shocks. When 30-year rates jumped from 3 to 7% in 2022, a standard $400,000 mortgage skyrocketed from about $1,700 to over $2,600 a month. That is a massive squeeze. Millions were priced out instantly, volume dropped, and it hit house flippers and independent brokers incredibly hard, squeezing their margins to 17-year lows. Finally, Part 6. Systems over sales. So if the transaction model is thin and customer acquisition is expensive, how do real empires get built? The smartest operators are aggressively shifting toward efficiency. Just look at AI adoption in property management. It nearly tripled in a single year, jumping from 20% to 58%. Smart systems are replacing manual data entry, detecting equipment failures before they happen, and generating pricing models way faster than human analysts. Operators scaling today are using tech to dramatically slash their fixed overhead. The takeaway here is that the most profitable companies are never at the mercy of a single market condition. They funnel their active transaction money into passive defensive models. Going back to those 7 models we talked about, the smart money uses the fast, unpredictable cash of a brokerage sale to fund a property management portfolio. Then, they use those steady, recurring management fees to survive the slow seasons. Finally, they pour those profits into direct asset ownership, achieving generational wealth through compounding, tax-sheltered appreciation. As the saying goes, the path from a local brokerage to a billion-dollar enterprise runs through one fundamental shift: stopping the selling of time and starting the selling of systems. Whether it's franchising an operational playbook to 169,000 agents or managing global corporate facilities for $40 billion in revenue, the ceiling only lifts when you detach your income from your own time. A standard brokerage sells time, but platforms and systems, they generate revenue regardless of whether an agent works on a Tuesday or a house sells on a Thursday. So as we wrap up this look into the complex reality of the real estate industry, I want to leave you with one final thought about where true scale really comes from. The biggest fortunes in real estate aren't made by selling one very expensive property. They're made by mastering the economics of all 7 models, understanding exactly where the margins truly live, and then building an ecosystem that pays you long after the final deal closes. The ultimate question is this: are you building a business that only sells your time, or are you building an empire that sells systems?